Hello, good morning. Welcome to day three. Um, Wait, let me just check the screen. Yeah, I think it is proper. So, hello everyone. I am Paritosh Panchal, and today we'll be solving some questions. All right. So three questions we'll be solving today. Zichiko. Now, this is a 50 mark uh, question. Then we have Hanwood shoes and Brandon. Hanwood and Brandon are both 25 marks each. Okay. So let's start with the smaller ones first. So I usually recommend in AFM starting with the 25 mark questions first because you're small, get done with it quickly, and then you have more time giving section A later. Right? So let's read. Now, before we start reading the question, let us read the requirements first. So we are required to explain how the functional area of a treasury department would add value to Brandon Company's restructuring plans. And for each functional area, discuss the advantage of a centralized treasury department. So this is a theory question for 6 marks, majorly highlighting the advantages of a centralized treasury department. And question number two, recommend a hedging strategy for $36 million loan based on the hedging choices of treasury management is considering if the central bank base rate increases to 6.6%. Support your answer with appropriate calculations. This is for 14 marks, and 5 marks is for professional skills. All right. We have discussed professional skills in day one, so you need to keep those pointers in mind, like your analysis skill, analysis and evaluation, your communication, your commercial acumen, your skepticism, all of that, right? So totally 25 marks. Now, since we know the requirement, we know it is some form of interest rate hedging. So now with that purpose, we can read and also some functions or advantage of centralized treasury. The following exhibits available on the left hand side. So see, on your CBE platform, all these questions in the exam, the question will be on the left hand side, and the right hand side, you will have your spreadsheet. Okay. Here, since these questions are not on the CBE platform, we have it written down on the spreadsheet and we'll be solving it over here. But I would always recommend using the CBE platform to practice. So, following exhibits, so Brandon Company transaction to be hedged. Um, the requirement would be so in your question on the left hand side there would be like two tabs, then Brandon Company and transaction to be hedged, so two different information will be given. So it's part of the same case study, but it just split for better presentation and ease of taking information. So this information should be used to answer the question requirement within your chosen response options. All right. Brandon Company is a holding company operating a small chain of luxury departments. Okay, just a moment before we start. I have to make a small change. Just a moment. I'll be back in a minute. Yeah. So Brandon Company is a holding company operating a small chain of luxury departmental stores in city center location throughout the Eurozone. Under the existing structure, the stores are grouped into a number of regional subsidiaries, each with their own head office and treasury function. So it's a luxury departmental store all across Eurozone. And well, currently it does not follow a centralized treasury, it has decentralized treasury. The board plans to undertake a restructuring exercise in response to a significant decline in revenue over recent years. This will involve closing unprofitable stores within the Eurozone while expanding into other more profitable locations worldwide. The proposal represents a significant expansion for the company and will be financed by a combination of debt and equity. So, They are trying to restructure. They are going to shut down certain loss-making units and expand, and not expand now in the Eurozone, but expand worldwide. Okay, so foreign exchange fluctuation will also impact them. The restructuring is due to be discussed at an upcoming board meeting, including the possibility of centralizing the treasury function. So this was the first information of Brandon Company, which spoke about the restructuring and spoke about just a moment. Yeah. Spoke about the restructuring, the expansion plans, what all it's planning to do, all of that. Okay. Now, part two is transaction to be hedged. So, just by reading this much, okay, would be sufficient for answering our first question, which has to do with centralized treasury. So you can highlight the advantages of centralized treasury with regards to, say, liquidity management. So if you have a centralized treasury, then you can manage your liquidity better because you know which subsidiary has shortfall, which has surplus. You can, uh, what do you say, transfer funds from one subsidiary to the other, help each other out. Okay, it's all like a bird eyes view. Okay, everything is under the center. All right, because what happens in decentralizes, one subsidiary may not know the liquidity condition of the other, right? And when you expand, your transactions also increase. Currently, your transaction would be less, so you are able to manage in a decentralized way. When it expands, it's better to have a centralized uh, treasury function. So you can highlight the liquidity management aspect of it, the benefits of centralized treasury. Then comes your currency management. So since they are going to expand worldwide, okay, they will be facing foreign exchange risk. Okay, so if there is a centralized treasury, then it knows how to match and net off certain inflows and outflows. So overall, the hedging will be done on a central level and not each individual subsidiary is hedging on their own, because that is just going to increase the cost of hedging. Also, for expansion, they will need funding. Okay. And so you can speak about the funding, like if it is centralized, so you are in a better source of, you can negotiate a better rate. And also you can see which assets and liabilities are, maturing at the same time, which you can match. Your ALM becomes easier, asset liability management becomes easier, okay, with centralized treasury. And corporate financing, again, from where which sources to fund, short-term funding, long-term funding, all of that. So you can mention all these advantage of centralized, what do you say, treasury. Okay. Now moving on to part two, transactions to be hedged. That is our interest rate hedging. Assuming today's date is 1st November, Brandon Company's treasury manager predicts a short-term loan of 36 million will be required next year on the 31st Jan to fund an investment in non-current asset as part of overseas expansion. The loan will be repaid on 31st of May, right? So, as I suggest, let's just make a small financial summary of this entire question. All right, so we have all the informations at one place. Now, this is as per your comfort level, whether you want to do this or not. But I suggest doing it so that we don't miss out any information and we not keep referring to the question every now and then. So today is 1st of November. Okay, 1st November. Then, so for you, it will be very simple because on the left-hand side is your information. You can just copy paste these things. I have to keep scrolling every now and then. So to avoid that scrolling, I'm also making that summary. Short-term loan is 36 million. Loan is required 31st Jan and will be paid back on 31st May. So 31st Jan and 30th May is the loan taken and loan repaid, right? loan amount is $36 million, right? Uh, yeah. Brandon company can borrow at the central bank base rate plus 40 bips. So borrowing is base plus 40 bips. The central bank rate is currently 5.7%. So current base rate is 5.7%. Interest rates have been relatively volatile over the last few years, and the finance director is concerned that the central bank would increase the base rate to 6.6% between now and 31st Jan in response to expectations about inflationary pressures within the economy. Recent media reports have also speculated on the possibility of reduction in the base rate. All right. So the Treasury feels that due to inflation, the interest rates may increase, whereas media reports have suggested or are speculating that there is a possibility of reduction. Okay, but the Treasury is fearing that increase in base rate of 6.6%, right? So possible increase of base rate to 6.6%, right? Brandon Company's treasury management. So this increase is expected to happen before the time we are planning to take our loan. That's why we are going to be faced with that risk. So Brandon Company's treasury management manager is considering the following hedging possibilities with objectives of minimizing the exposure to interest rate risk. Why do we hedge? To minimize our exposure to interest rate risk. Um, Forward rate agreements, interest rate futures, that is FRA, IRF, and options on IRF. The following data is available for each of the following. So we have these FRAs, all right. So this seems to be a very straightforward question. So the details have been given to us, and we are asked that which of the um, method is a better way for Brandon Company to hedge their interest rate. So whatever is cheapest because they want to try to minimize their exposure to interest rate risk, right? Um, so FRA is pretty straightforward, as we know. In IRF, they are standardized contract and options against standardized contract, but FRA and IRF both are obligations. Options give you that flexibility. Right, so let's calculate. Now, the information given is the following FRA rates are available. So we'll start off first with FRA. So firstly, label. So we have already answered A, we have discussed rather. Now, subsection B, so we can just write in question 3, subsection B, all right? And then we'll highlight that these are FRAs that we are evaluating right now. Okay, or we could just say hedging. Wait a minute. Yeah. Hedging with FRAs. All right. So present your answer in a very uh, clean and easy to understand manner. So you're giving headings for everything. So hedging with FRAs. Now we have three FRAs to choose from. So it's either 3v4, 3v7, 4v8. Now, as we know that 3 is the number of months in which the loan is actually taken, and 4 is the number of months after which the loan will be repaid. Okay, so today it is 1st of November. Okay, we need to take the loan on 31st of Jan. So 1st November, the entire month, December, the entire month, and Jan, the entire month. So that's 3 months. So our loan is going to start in 3 months. And when are we going to pay it? So after Jan, we have March, April, the entire month, and May, the entire month. Okay. So, wait. So, so November, December, Jan, Feb, March, April, and May. So 7 months. That is, it's end of May. So 7 months. So it will be 3V7. Okay. So this is the FRA we are going to select. So we will just write that. Uh, we shall hedge with 3V7, 5.9% FRA, as funds will be required after 3 months and shall be repaid in uh, 7 months from now. Okay, that is, it's a 4 month loan required. All right. So give now again, you need not write the entire thing that 3 months and 7 months and then 4 months. You can just say it's a 3 month loan and it's need to be repaid within 4 months. So it's understood that, uh, or you can just say we are going to take a loan after 3 months for 4 months. Okay, you can keep it as short as that also, no problem. Just a moment, let me just text wrap this. All right. So we have established Y 5.9% FRA. Now, they say that now we have okay. So here they said that considering that the interest rate increases to 6.6%. So if the central bank, this is the base rate, okay, central bank rate, can also say base rate, increases to 6.6%, then what happens? All right. First thing that would happen is we will take the loan as normal. So interest payment on actual loan at spot rate. Okay. So we will take the actual loan. So let's just put in that all these figures are in dollar terms. Okay. So we are taking how many? $36 million loan. So 36 million. Actually, let me just write 36 million over here. So we can always just self-refer to it. And here we know that the commas are properly, because when we are manually entering number and what if we miss out on 1 0 or something of that sort, our answer could go wrong, right? So $36 million into 6.6%. Now this rate is for 12. Okay. Now, sorry. So the base, we are able to take a loan at base plus 40. So what we are going to do is base rate is 6.6% plus 40 bips. So 40 bips is nothing but 0.4%. Okay. So this is our interest rate. Now this interest rate is for the entire year. So, but we need a loan for only 4 months. 4 divided by 12. Okay. You can in fact just write over here also that what do you say? Maturity period of loan is 4 months. Okay, just to make it clear for you. So $840,000 is the interest payment on the actual loan. And then you are going to figure out that are you going to make a profit or a loss in case of FRA. So now rates have increased to 6.6. However, you have an obligation at 5.9. That means profit from FRA. So it's a profit from FRA, which is basically a receipt from FRA bank. Okay, so whichever is your from whichever institution or bank you have, FRA institution or FRA bank or institution, anything you can just. All right, so since you are making a profit now, how much profit are you making? So is equal to, see the actual rate, actual base rate. Now understand this, the FRA rate, which is 5.9, is going to be base rate alone. It's not going to factor in the spread. All right. So the profit that you are making, you are going to compare the base rate to a base rate. So 6.6% is the actual base rate, but you have an obligation at 5.9%. Okay. So the differential is your profit into 4 months divided by 12 months into 36 million. All right. So 84,000 rupees is the profit. Now 840,000 is the outflow. This is an outflow. This is an inflow. Okay, so net you have to pay is this minus this. That is $756,000. So this is your net borrowing or net cost of borrowing. Okay, or interest you could say. All right. So this is your net. So what is your effective rate of borrowing? So very simple. You will take your interest divided by your principal into you will adjust it for the months because it's not for the entire year. So your effective annual interest rate will be this divided by the total, that is your interest divided by the principal into 12 by 4, because this is a 4 monthly rate. So you need to find out what is the annual rate. Now this will be a percentage. So you can highlight this also, 6.3%, right? You can just in fact highlight it this way, that your effective annual rate is 6.3% if you hedge with FRAs. Now you can say hedging, sorry, forgot the G, went into American slang English, is hedging with your interest rate futures, so IRF. Okay. Now, or you can just use the terms that they have used over here. Do not use short forms. So they have written futures, so we will also mention futures over here. I think where was it? Yeah, IRF. Okay, here they have written FRAs. I would always suggest writing the full form. So hedging with interest rate futures, which is IRF. All right. Would hardly take you some time, but just to be on the safe side, write full forms hedging with forward rate agreements. Okay, so you could write that. I'm not gonna write it. So now the questions for regarding IRF, as in question, the three questions that we ask is, firstly, do we buy or sell for hedging using futures? And secondly, do we which expiry do we select? Okay, and then we pay the margin amount. Now, let's find out that how much, which FRA or how many. Firstly, what do we do? Okay, so we need to borrow money. So remember the underlying that we consider for IRF are bonds. Okay, so if you are going to borrow money, we are going to sell bonds, that is issue bonds. All right. Since we are going to sell bonds, we are going to sell futures. Okay. Um, since we are hedging or borrowing, we we shall sell IRS to hedge against any likely increase in fu- uh, in interest rates or in future interest rates. Okay, so we are going to sell IRF. You can also write that in the first. So sell IRF and then the reason why, because it's a borrowing. Okay. And in the back of your mind, you know that the whole reason is because you are selling bonds and therefore you are going to sell IRF. Okay. And we select the maturity immediately. The contract which is maturing immediately after the transaction date. So we know that the transaction date, when are we going to actually take the loan? 31st Jan. So whichever is expiring after 31st Jan, we shall take. So let's see our options or the contracts available. December, March, and June. So December is before Jan, March is after Jan, and June is also after Jan. But we take immediately after. Okay, so immediately after will be March. All right. So we shall sell March. Okay, what was the rate? March IRF at 93.95. 93.95, right? We shall sell March IRF at 93.95 as it is expiring immediately after the uh, transaction date, that is 31st Jan. All right. Or we could say the loan date also, or the date on which the loan is taken, whatever. But basically, you are giving a reason that why we are taking or why are we selling uh, March contracts. All right. Now, the third question is how many contracts are we going to sell? So we have a formula for it. So number of contracts will be equal to, now how much is the requirement? The requirement is of 36 million. Now this 36 million, and what is the size of that one contract? One contract size is $500,000. $500,000. Okay. Now these are so see, the options and the IRF contract size is usually the same because the underlying for options are IRF. Um, it's a 3-month contract. All right. So into now, how many months do we need the loan for? We need the loan for 4 months divided by the contract duration, which is 3 months. Okay. So it is 96 contracts. This is not a figure. Its number of contracts is 96 contracts. All right. The formula is pretty simple. What is your requirement divided by standard size into, for how long is that requirement? For 4 months in this case, divided by what is the, how long is the contract for? Okay, that is a 3-monthly contract. Okay, so now don't get confused that, oh, we are taking the contract in Jan, expiry is of March, so it will be Jan. Sorry, we are taking, when are we taking? 1st of November. So November, December, Jan, Feb, March. Okay, it's not a 5 monthly contract. It's clearly mentioned explicitly over here. It's a 3 month dollar future contract of $500,000 is the lot size. Okay, so 500 contracts or lots. Okay, the technical term is lots. So we are going to take 96 lots. Okay, take as in we are going to sell 96. So finally, we are going to sell 96 lots of March IRF at the rate of 93.95. Okay, so you can just make this as a bold. This is your final conclusion. Okay, now we can do the calculations. Before we do the calculations, there is also, we need to find the basis. That is, let us just see if they have given us the, on the transaction date, if they have given us the future price. Okay, so prices are quoted in basis points. This is very standard way of quoting price. So they have just explicitly mentioned that prices are quoted in basis points, and a basis point is nothing but 1% is equal to 100 basis points. Now, December contract, March, June, and then we have options, $500,000 contract. You have your strike price with your calls and puts option. Assume further, assume futures and option contracts are settled at the end of each month. That means the expiry is at the end of the month. Base is assumed to diminish at zero at contract maturity at a constant rate based on monthly time intervals. It is also assumed that there is no basis risk and there are no margin requirements. Okay. Uh, so these assumptions we can highlight that note that we are assuming, or as per the question, we are assuming no margin, no basis risk, and basis diminishes to zero in a linear or a constant rate. Okay, so we don't have the future price because so we don't know whether how much profit we'll be making in futures. So let us find profit or loss, how much we are making in futures. So let us find out the basis, okay, or the unexpired basis. So we have basis over here. So current spot price, or we could just say that today, or wait, let me just do it like this. That so spot price, then future price or spot rate rather. I'll just leave spot and future instead of, okay, and basis, right? So currently, what is the spot? The spot is 5.7%. Okay, so the spot is actually 5.7%. Okay, and the future price is 93.95. Now we can do either or. We can either change the spot into future, the way how future prices are quoted, or we can change future into the way spot rates are quoted. For ease of calculation, we'll convert spot rates into future prices. So it's basically, it's no longer a percentage, it's 100 minus 5.7, because it was 5.7%. So 100 minus 5.7 will be equal to 94.3. Now basis is nothing but spot minus futures. Okay. So this is how, sorry. Yeah. So this is how you get your unexpired basis. This is unexpired basis, right? So this is the unexpired basis as of today. Now, this is today. So this is, today is 1st November. All right. Then on, a loan is taken on 31st Jan. So on 31st Jan and 31st March is when the contract is expiring. Okay, we don't know the spot nor the future rate on 31st March, but we know that unexpired basis will become 0 on that date. Okay, this is an so if you read the assumption, it is expiring. See, firstly, it is a fact that it will expire to 0 on maturity or on expiry. Okay, what we assume is it diminishes to 0 in a constant way. So from 0.35 to to 0, okay, it is equal every month, equally it keeps falling. So now we need to calculate how many months are left for expiry. Okay, months left for expiry. All right, let me just take this all one cell ahead. Okay, yeah. So this we found out unexpired basis. Now months left for expiry. So from 1st November, December, Jan, Feb, March. So that's 5 months left. Okay. And from 31st Jan, so Feb entire month, March entire month. So that's 2 months. All right. So that's your now how do we calculate the unexpired basis as on 31st Jan? Very simple. If it's this into 2 divided by 5, it's like a cross multiplication. Okay, so 0.14 is the unexpired basis. We don't know the future rate. We do know the spot rate. We are saying that the spot price increases to 6.6%. So that is 100 minus 6.6. Okay, that's 93.4. So you will just do this minus this is equal to 93.26. Okay, so this is our future rate over year, right? In fact, all of these are calculated, but we did all this calculation for future rate. Now, if you do not want to do it in this table format, you can do it in whatever way you are comfortable with. Okay, this just for your understanding, so that you understand how bases are calculated and how to arrive at future rates using this unexpired basis. I have done it. So we have found out the future price basis. So this you could say is basis and expected future price on 31st Jan. All right, so we are calculating those two things over here. Now next, now we can also write that over here. In fact, you can write note as per the question, or rather as per the information given in the question, we ignore. What are we asked to ignore? Uh, we ignore, or we assume, and you can just copy paste the assumption. There is no basis risk and there is no margin requirement. So we are not calculating the margin requirements in this case. Okay. Also, basis is assumed to diminish to 0 at maturity at a constant rate. Okay, on monthly intervals. In fact, you could just copy paste that whole thing. So you are just making the examiner aware that yes, I know that I have made this assumption. Sorry, the lights just fell. Wait, let me just fix that. Give me a minute, please. Okay, I think the lighting is now proper. Just a moment. Yeah, the lighting is now proper. Okay, coming back to our question. So yeah, as I was saying that you just have to copy paste this assumption that so you're just making the examiner aware that these are the assumptions that we have been making, and the reason also for it. Even if these assumptions are not explicitly given in the question, you may want to give these assumptions, make these assumptions, even if it is not in the question. Okay, so you would just write assumption. Right, and let me just text wrap it. Right. Okay, so we found our basis and expected expiry future price on expiry. Now, the transactions that would actually happen. So, firstly, so this is as on 31st Jan. Okay, these are the transactions that are happening. So now the interest rate, we'll just copy these. Okay, light fell again. I don't know what's the issue. Just give me a moment, please. Sorry about this. Yeah, I think it is proper now. Hope it stays that way. All right. So interest payment will be same as usual. Okay. So we need not recalculate it. You could just copy paste it from above, or you could cell reference it to the above this thing, or you can just copy paste the entire calculation because it's cell reference. So everything will be as it is. If you copy paste the cell, then the cell referencing would move. You would want to copy paste the entire formula from the formula bar. Okay. So yeah, your this is the actual loan that you are taking. Now profits. Now we don't know whether it's a profit or loss, but let's just see that we have sold it at 93.95. To square it off, we'll have to buy it at 93.26. That means we are going to make a profit because we are selling it at a higher rate and buying it at a lower rate. So profits from IRF. Okay, now this is not a receipt from a bank or anything. Okay, it's just the market. So we don't know who's paying it, but the exchange is basically giving us this much. Now, what is the profit that we are earning? So we are earning a profit of now remember these 93.26 are basically in bips. Okay, these rates are quoted in bips. So we'll write it as point. We are selling it for 0.9395 minus we are buying it for 0.9326. Okay, so that is our profit per contract. All right. Now we are selling like that 96 contracts. Each contract is for 3 months out of 12. Okay. and into the size of the contract, that is 500,000 contract size. So let's just format it this way. So that is $82,800. Okay. Now the net cost of borrowing, let's just see if the calculation is done correctly. Yes, it is done correctly. Now the effective annual rate is nothing but this divided by our principal amount, or what I'll do is I'll just check which cell reference has gone missed. This is proper, but the other one it has taken this. It's not H88. It will be, so this cell is wrong. It's shifted basically. Okay, it will be this. In fact, let me just lock this. So why didn't it work? Okay, it didn't take it properly. Wait, it is D53. Yeah, D53. We are locking it, and then we need H. So this cell will be, wait a minute, H88. Okay, so this is our annual effective. Wait, why is it such a big number? Wait, let me just redo the whole thing. Okay, so it is our interest divided by this. This is locked into, it's we want to annualize it, so into 12 divided by 4. Okay, so 6.31% is our effective annual rate. This one was 6.3, 6.31. So a minor difference, but FRA is cheaper, even in the whole amount, 756 versus 757.2. Okay, so 756 is cheaper. So far, FRAs are cheaper than IRF, and it's highly unlikely that options are going to be any cheaper because what is happening over here is there is an adverse movement, and options are more expensive than your IRFs. But they have asked us to calculate it, so we might as well just do it. So our options. So if options were not asked, we could have directly found out the effective annual interest rates by your shortcut method. Okay. Now options. Remember, whenever you're calculating interest rate payment, we have to take into consideration the extra, because it's base plus the spread. Okay. Now options on IRF or hedging with options on IRF. Okay, so now the question is again a three standard question. Which expiry, how many contracts, and whether a call or a put. Okay, so are we buying or selling? So see, it becomes very easy once we have done IRF. We know it is we are selling for hedging. Okay, so therefore we need to buy the right to sell. Okay, so put option. Now we also know the expiry March. So once that decision is taken in IRF, in puts, it becomes all the more easier. Now there is another decision which needs to be made, but fortunately in this question we need not make it. Is which strike price? So we have to see the net cost. Okay, the premium cost for each strike, and what is the effective or the implied rate, and accordingly we will select whichever is the cheaper option. Okay, now in this case there is only one strike price, so we need not do that. So it's March 0.087 will be our premium that we pay, and strike price is fixed. So what we are going to say is we are going to buy March put options, okay, to hedge against to hedge our borrowing. Okay, you could just write it borrowing against likely increase in interest rates. Okay, number of contracts required, again it will be just like, because the size of the contract and everything is same as futures, so we need not calculate it, or you could just copy paste the same thing, right? Number of contracts is equal to, now since it's cell referencing, so we cannot copy paste the cell, we have to copy paste the formula bar. Okay, we have to copy paste this entire thing. So I'm just writing it just as in case of IRF. So you could just take that above figure and that's it. And you can write just in case of IRF, we shall sell 96 contracts. Okay. So we could just write, not sell, sorry, buy. Okay. So we'll buy 96 lots of March put options and pay a premium. Okay. March 96, what is the strike price? The strike price is, just a moment. All right, sorry about that. Um, so I'll just repeat. Okay, I'll just repeat myself because that thing happened. Anyways, so we are talking about options, hedging with options. We decided just like above, which is IRF. Okay, we are going to, in IRF we sold, therefore we are going to buy the right to sell. That is, we are going to buy March put options. How many contracts? Same as above. That is same as in case of IRF. That is 96 lots. We are going to sell. Okay, sell as in we are going to buy the right to sell. Okay, buying the put option. So buy 96 lots of March put options and pay. Now we have to write the premium. Also, March put option. So we have to quote the exercise price or the strike price. The strike price is 93.75. Okay, so March 93.75 put options and pay a premium of, now let's calculate how much premium are we going to pay. Okay, in futures, there was no margin. They asked us to ignore the margin, so we didn't calculate the margin requirements. Okay, we just have to calculate our um, premium in over here. Okay, so our premium is equal to, what is the premium given over there in the question? 0.087. Okay, so this is again in bips, so it's basically 0.087 divided by 100, because it's bips, okay, into the contract size. One contract is of $500,000. Okay, the duration is 3 months, so 3 by 12 into how many such contracts? 96 contracts. Okay, so your premium is $10,440. Okay, so you could in fact write this conclusion at the very end. Okay, so this is like the end thing that you are doing, paying a premium of dollar 10,440 total. Okay, so for 96 lots, you are paying this. You could say is total premium. Okay, now we just have to write down how much is the effect over here. So firstly, we'll say if base rate, or rather this we could say, if base rate increases to 6.6%, right? This over here also we could, now we could just combine these two statements anyways, it's fine. So here we'll write, oops, where it go? Okay. Our exercise prices, 93.75. Okay. Then what is our strike price? Sorry, strike price is already written. Now what is our future price expected? So our expected future price, we have calculated it above, is going to be 93.26. So the question is, would you want to exercise? Okay, exercise the option. Are you going to exercise the option? Now tell me whether you will exercise the option or not. So you have the right to sell it at 93.75. Then why would you sell it at a lower price? That is 93.26. So you would want to exercise it. Okay, so this is a yes. Now you will say gain in, let's make it easier, gain in basis points. Okay, because all these pricing are in basis points. So how much are you gaining? This minus this. So that's 0.49 bips is what you are gaining. So 0.49 divided by 100 is basically what you're gaining. Now, interest payment as usual. Okay, let me just copy paste the formula, right? This is our, wait, why did it come in blue? Okay, this is our outflow. And see, so if you have observed that the actual interest that we pay is going to be the same everywhere, right? Now, we need to ask is what is the profit that we are earning on this? Let me just copy paste this whole thing. Okay, so profit on options. We already calculated how much we are gaining. So we are gaining 49 bips. So 49 divided by 100. Okay. Now this is for one contract. We know that there are 96 contracts and each contract is of $500,000. Okay. For 3 months divided by 12. Okay. So 58,800 is the inflow that we are getting. And there is also one more. In case of options, we pay a premium. Okay, we are paying a premium. So premium we have already calculated to be 10,440. Just referring to that. Okay, this again is an outflow. All right. So we will say this is an outflow, this is an outflow, and this is an inflow. So our net borrowing cost becomes 791.640. And effective annual rate has been auto-calc. Since we have fixed the cell, okay, we have put the dollar signs in, so it has calculated it properly. So 6.6%, which is the most expensive, which is in line with what we had thought initially. Okay, in fact, you could just give this also a heading so they know that you could just maybe, or no need. We have anyways highlighted effective annual interest rate while hedging with options. This is effective annual rate while hedging with IRFs. Okay. And effective annual rate while hedging with FRAs. So you can clearly see that this is the least. All right. So you can give a conclusion as per that. So your conclusion or your advice will be that the FRA, as per the calculations above, the FRA is the least expensive way for Brandon Company to hedge with an effective or with a net effective cost of borrowing of how much was it? 6.3%. 3%. Okay. Now, this is the major advice that you are giving. However, you do not restrict yourself. This is what most students would write. Okay, they will just stop over here. Wait, let me just, yeah. They'll just stop it over here, right? But you need to mention about other things and some features about FRA. Okay. So you can say, right, both FRA and IRF are obligations and effectively fixes an interest rate not okay, or effectively fixes an interest rate, in which case one cannot take or one cannot enjoy the benefits in case of favorable movement of rates. Okay. So you are also highlighting that FRA is inexpensive, but FRA and IRF both. Okay. In fact, above you could also mention that. All right, I'm not going to write all these things because it's just taking a lot of time. We are anyways running a little behind time. Wait, let me just merge this and format it. Okay. So again, I'm just leaving this halfway, but I'll just speak it and you can write it accordingly. So we are first saying that out of the three options above, FRA is the cheapest at 6.3. You can say though it is very close to 6.31 of IRF. Okay, and there is no real advantage between FRA and IRF in this particular case because you are fully hedged in IRF over here also. So that advantage of it being OTC is not there in this particular case. As in, obviously it is OTC, but here you are not under hedging or over hedging yourself. It is a perfect hedge. However, futures are you see we have taken an assumption. This is an expected value based on the assumption that expire the unexpired basis reduced to zero in a constant manner. Okay, but if that wasn't the case in reality, and in reality it could reduce at whatever rate it feels like, okay, then this rate could be either more or less. All right, so though these two are very close to each other, 6.3 and 6.31, we are better off with 6.3. Reason being it is cheaper, and secondly there is no basis risk. Okay, uh, so I'll just write it least expensive way. Also no basis risk which IRF faces. Okay. So you are mentioning why FRA least expensive, also no basis risk. Then you are saying that both IRF and FRA will essentially lock it, and it's an obligation. And since interest rates are increasing to 6.6%, that is why options are the worst case scenario. Okay. However, if there is any probability, because there was a statement over there that media is speculating that interest rates could come down. So if that speculations come true, then maybe options would be beneficial because options can take advantage of that reduction in rate. All right. So you mentioned that as in you put forth that point. So these are all points you need to include in your conclusion. You shouldn't be writing a one line conclusion because the conclusions have a 2-3 marks attached to it. Let's see how much is it for the conclusion. Um, Okay, it's total 14. They haven't given the split, but there are professional marks. Okay, so when you write a proper conclusion, you do get awarded those professional marks. Okay, so you are saying, so you are going beyond what is asked. You are also making them aware that yes, if it is 6.6, it is FRA for sure. But if the other thing happens, that is if there is a reduction in rate, then options could be beneficial because option allows the investor to take advantage of any favorable movement in interest rates. Okay, so the treasury really needs to find out that which case has a greater probability. Do they think that there is a high probability of interest rates rising or falling down? Okay, and as per that they can select it, or they may want to recalculate that if it falls down then to how much. Okay, So you are going, all this is your professional marks. So you can write this in your advice. Okay. We'll take a quick 10 minutes break, come back and move on to the next question. I know we took a lot of time, but I was explaining each and every step and I was doing these extra presentation, which in exam you need not do. You can directly start calculating your answers. Okay. And save time that way. If you see, this is a very typical interest rate hedging question and very, very simple. You just had to follow steps. There were not a lot of tricks or anything in this question. If you get a question like this, you should be super happy in exam and you should easily score, if not 25, then at least 20 plus. Okay, in this question, because 20 marks are for your calculations, okay, or rather 14 marks are for your calculation, 6 marks for advantages, disadvantages, with sorry, advantages majorly, which again is easy, but I understand theory can be difficult. So even if you score 3 marks from here, so 14 plus 3 is 17, and 3 marks from professional, so at least 20 marks you can easily score in this question. Okay, if not, ideally full would be great, but minimum 20 you should be easily scoring. Okay, remember this is important, the advantages of a centralized treasury department. So revise that if you haven't already. Okay, keep that in mind. And well, yeah, so this is your guaranteed question on guaranteed question, as in not the same type, but you are guaranteed one question from your uh, hedging, okay, or risk management and treasury management. All right, so this will be you could just highlight this whole thing over here. Again, not only this much, the entire two paragraphs that you write. Okay, first paragraph is just talking about which is better, and second paragraph is talking about why options could also be considered if in case there is a drop in interest rates. Okay, here we have always assumed that it increases to 6.6, the base rate. All right, so 10 minutes break and then we'll be back. All right, welcome back. So let's start with question number 2, Hanwood shoes. Now, before we read the question, let's just quickly go through the requirements. Calculate the expected sale price of children's shoe division and demonstrate the impact on Hanwood Shoes Company statement of financial position forecasted earnings per share. So, two things we need to calculate. The sale price on the sale of a division, and what is the impact of that sale on the financial position as well as the EPS, right? Discuss whether Hanwood Shoes investors are likely to be satisfied with the proposed sale of children's shoe division and its consequences of profits and funding. Okay, so this seems to be like a theory question. Okay, we have to just discuss about it. All right, so let's read the question. Hanwood Shoes Company started trading 40 years ago, manufacturing and selling children's shoes in shop. The shoe have been of higher quality than shoes produced by its competitors, although also more expensive. School shoes sale in particular have been consistently large. Just a moment. Sorry. Uh, School shoe sales in particular have been consistently large generator of cash, helping to fund the company's expansion. About 15 years ago, Hanwood Shoes Company started manufacturing and selling adult shoes. Uh, yeah. Hanwood Shoes Company's adult shoes are currently sold at a higher profit margin than children's shoes. Adult shoe sales now generate the majority of Hanwood Shoes Company's profit. So now adult shoes is having a better share in the profits. The adult shoes sold are a mixture of formal types and a long lifespan and some fashionable shoes. The inventory turnover period for adult shoes is on average, where did it go? On average, significantly higher than that for the children's shoes. So inventory turnover is much better for adult shoes, which is an indication that it's either selling quickly. Hanwood Shoes is organized on basis of two separate divisions for children and adult shoes. Its shops sell either children's shoes or adult shoes, but not both. So in one store, it would have either or the two. But so Hanwood Shoes also sells adult shoes to other retailers. 5 years ago, Hanwood Shoes reconstructed or restructured its cost base. It moved production of children costs to new facilities in its home country and outsourced the production of adult shoes to foreign suppliers. However, Hanwood Shoes board now predicts that the profits from children's shoes will increase at a slower rate than adult shoes. It expects that in the next few years, a greater share of children's shoes market will be taken by companies with lower cost base. Okay. Hanwood Shoes board is aware that it must convince investors that any major strategic change it makes will result in increase in EPS. Investors will also consider a change in earnings per share against any change in business risk profile of the company. Now, the sale of this is the main, I think, speaking about the sale, this was just a backstory, but again, it's going to help us answer the part B. Sale of children's shoes division. Hanwood Shoes Company board wishes to improve the company's cash flow for two reasons. Firstly, the loan of 175 million nominal value are due to be redeemed in just over a year's time. The board is unwilling to seek renewed loan funding because of the terms would not be favorable, and soon investors have expressed concern about gearing levels. So this 170 million which are due to be redeemed, okay, the once they are redeemed, they are not planning to take a new loan. Okay, so we'll just write that, or we'll just keep it at, or okay, wait. Okay, $1 million. Yeah. The board is unwilling to seek renewed loan funding because the terms would not be favorable, and some investors have expressed concern about gearing levels. Secondly, Hanwood Shoes has recently been slow to pay some of its suppliers of adult shoes. One major supplier recently delayed delivery of shoes to Hanwood Company until it was paid for previous deliveries. Okay, so there is some liquidity issue also. So that is another reason they do not want to take more loan, because more financial stress, as in renew their loan. Hanwood Shoes Company's chief executive proposed that the company should in future only sell adult shoes and should sell the children shoes division. So selling off the children shoe division. He believed from the industry contacts that at least three children's clothing manufacturer looking to expand their products range would be interested. The finance director suggested that the proceeds from the sale of the division could first be used to pay off the loan notes. It would be used to increase cash held and thus improve liquidity. The remaining proceeds would be invested in adult shoes division to improve EPS. Okay, so the whole plan is to sell off the children's division, improve your liquidity level, pay off for the loan, because it anyways have a crash crunch. So it can pay off the loan and not take a new loan then, maybe, and have improved liquidity, invest in assets, expand their other division more, and generate better returns over there. Impact and consequences of the sale. The sale price of children's shoe division will be the sum of present value of predicted future cash flows. The discounted rate to be used is 10%. So it is a DCF method that they are suggesting to calculate the present value, or rather the price of the children's division, and they are suggesting a discounting rate of 10%. Okay, so your cost of capital or discounting rate is 10%. The predicted after tax cash flows of children's shoe division are as follows. So all figures are in millions. So what we can do is, so what is this question number 2, subsection A? Okay, we can just write question 2 A. We can copy paste that table over here. Give it a title. What is this? We can say that selling price, or sales proceeds, or proceeds from selling of the children shoe division. Okay. Yeah, so all figures are in $1,000,000, so we'll just keep it as is. So we have the sales. This is our what are these figures? These are the after-tax free cash flows. So after tax free FCF, I'll just write it in short. Okay. So after tax free cash flows are these. What else do we have? Now they say that they are being discounted at a 10%, but let's see if there's anything else. Predicted after tax profits of the children's shoe division in year one can be assumed to be $76 million. The total after tax profits for Hanwood. So profits we are not requiring at the moment. We would need that when we are calculating EPS, but so we can ignore it for now. After year four, free cash flows for children's shoe division would be assumed to increase at a rate of 3.5% per year. So that's the terminal growth rate. The proceeds received for selling shoes division would be pay off the loan and the current rate. Okay, so I don't think any other information, the profit on sale of shoes reserve, the non-current can be assumed to be. So on in case of valuation, nothing else is given. So it's just these two information. Sorry, this and this. So we already have our free cash flows, we can just discount it. So discounting factor at 10% is equal to 1 divided by 1.1, that is 1 plus r raised to n, right? Just to, sorry. Okay, so we have our discounting factor. Then we can find our PV, this into this, right? And our total present value is sum of these. Okay, that's $260 million. All right. Now we also have a terminal growth rate. So terminal growth rate from year 5 onwards, which is I think 3.5. Where is it? Yeah, 3.5%. Okay. So PV or PV of terminal value. Okay, so we are going to take, well, it's a growth of 3.5%. So firstly, what is our last cash flow? 88 million into 1 plus G. So 1 plus 3.5%. Okay. Divided by, now it's a perpetual discounting. So KE minus G. Our KE or discounting rate is 10%. So 0.1. Okay. Or I can just write it as 10% minus G, which is 3.5%. Okay. Uh, so this, however, this is from year 5 onwards, so we need to further discount it. Okay. So into this, it's a double. It's like an you can treat it like an advanced perpetuity. Sorry, delayed perpetuity. Okay, the perpetuity is starting from year 5 onwards. So when you just do normal perpetual discounting, it is as on year 5. Okay, we have to find it as on year 4. So we are sorry, it's coming as on year 4. Okay, we need to further discount it to get year 0. So our final value will be wait, let me just, these many $1 million. Okay, I'm getting some questions asking that it's not clear why did we double discount now. So just imagine, say this is year 5. Okay, this is year 5. Sorry. Now they are saying instead of 88, it's going to grow 88 into 3.5%. Okay, and this till infinity is going to be, sorry, is going to be 3.08. Okay, sorry, it's 1 plus r. So till infinity, it's going to be this much, 91.08. It's going to go keep going. So we are going to do an annuity discounting. All right, or sorry, not annuity, perpetuity discounting. Now the perpetuity discounting formula is perpetual discounting with growth will be KE minus G. Okay, 1 divided by KE minus G. So we are multiplying it, or rather dividing it with 1. See, if you're multiplying it, you will do into 1 divided by KE minus G. Since we are directly doing it, we are just doing divided by KE minus G. Okay, that's normal discounting. Now, when you discount it, okay, of year 5 onwards, okay, now you are not taking discounting rate from the 5th year onwards, you are taking 5 years discounting rate. Okay, uh, so the present value will be as of year 4. See, when we discount these, it's going 1 year back. Okay, all of these, when we find the summation of this, is basically present value. That is as of year 0. So you have to discount it again by fourth year, because whatever answer you are getting is as on year 4. So you have to discount it again with 0.6830, which we have done over here. Okay, and finding the present value, that is as on year 0, right? So this is our final for our final terminal value. So our total, so we can just highlight these two. Okay, so we can say the total PV of the children's shoe division, or the sales proceeds, because the present value is what we are going to get, is equal to this plus this. So $1,217. Okay, sorry. So this is the total present value or the sales proceed of the children's shoe division, which answers part of question A. So they asked us what is the expected sale price. So we could say expected sales proceeds. Okay. Right. Now, what is the impact on the financial position as well as the EPS? So we have the financial position. We have to find out what are the impacts. So let's read what all changes are happening. We'll do financial statement first because it would be easier since the statement is already given to us. The predicted after tax, so this has to do with after tax profits, so your EPS. So we'll refer to this a little later. Year 4 free cash flows for the children's shoe division should be assumed to increase at a rate of 3.5% per year. The proceeds received for selling the children's shoes division would first be used to pay off a 9% loan note. Part of the remaining amount from the sales proceed will be held as part of current assets so that the current ratio increases to 1.4. The rest of the sale proceeds will be reinvested or will be invested in non-current assets. So with this money that you are getting, okay, you are selling, you are reducing your loan notes, you are doing certain adjustments to your current ratios. That is, you are adding to your current asset and adding to your non-current assets. So three things you are doing with that money. Okay, so let's first see. Okay, let's just read everything. The profits on sale of children's shoes division would be taken directly into reserves. The non-current assets of children's shoes division can be assumed to be $608 million, and the current asset can be assumed to be $349 million. Okay, that this is the non-current assets of children's shoes division. Okay. The additional investment in non-current asset is expected to earn an 18% pre-tax return, and additional investment in current asset is expected to earn 6% pre-tax return. Tax is payable on an annual rate of 20%, and then we have our balance sheet and P&L. Okay. So, firstly, this is still question to subsection A only because there's an and. That's why it's important to read the entire question. They didn't only just ask us the sales proceed, they also asked us the impact on it. So we'll just write impact on statement of financial position, and everything will be in dollar million. Okay, so a nicely labeled heading. First and foremost, This is the total cash flow. Okay. Cash inflow, total expected cash inflow on sale of children division, okay, is equal to 1000. Okay, now we have already written dollar million, so I'm not going to keep mentioning that. All right. Now this is what we sold off, and as in we got cash for it. But what did we sold off? How is our balance sheet changing? Okay, so the year they have mentioned that yeah. So non-current assets, reduction in non-current assets and current assets is 349. Okay, so we can just now I'll just write it directly since there's a shortage of time. So I'll just write directly profit on sale is equal to this minus what was the reduction in assets? 608 minus 349. Okay, so 260 is the profit on sale, $260 million. Or what we can also do is, let me just copy paste this entire thing over here. So what is happening is this non-current asset is getting reduced by, because since we are selling it off, non-current assets is getting reduced by 608, which means there were some fixed assets and 349. So we are selling this. Okay. Current asset, non-current. So our profit on sale. So our profit on sale is there. Now, next thing what we find is, let's see what else is there. Right, let's just highlight this. Okay. Now, what else? What are we doing with this sales proceed? Okay, so we are reducing our loans. Okay, we are first using this to paying our loan. So 9% loan. Where is our loan? This basically becomes on sale. Okay, we are reducing this entire thing. All right. So it will become 0. All right. 9% loan notes we are paying off. That's what they have written. First be used to pay off 9% loan notes, and part of the remaining amount from the sale proceed will be held as part of current assets so that the current ratio increases to 1.4. So now we want to make our current ratio as 1.4, which basically means that our new current ratio will be, or rather, so new current ratio, that is post sale, is expected to be 1.4. Therefore, new current assets will be 1.4 times the liability. So current liability is 894. So 1252 is what we are expecting our new current assets to be. All right. Therefore, so now how much is the increase that we have to do? Increase in current assets will be, now we have to reach or additional investments, you could rather call it, in current assets will be, now you already know that the end, that is, wait, this is current, this is uh, post sale. Okay, now this is a forecast because we haven't sold it yet. So whatever numbers are just forecast. Now we know that this final non-current asset post sale has to be 1252. Okay. Uh, Sorry, current asset, not non-current asset. This needs to be 1252. That means we are buying additional. Now, how much is that additional? We know that previously, okay, we know that 1252 is what we need. Okay, and 349 is what we already sold, or we could just say that minus. What did we earlier have? We earlier had this, and we know that we are selling off this. Okay, so the additional investment that is required, right? 1252 909 minus 349. Yeah. So the additional investment that we require is $6 million, or wait, why is it 6.4? Wait, just a moment. Uh, okay, current assets currently are 909 million, 349 million. Wait, yeah, something I've done wrong. Wait, I'll just recalculate it. So I know that I have a requirement of uh, is this correct? Yeah, into 1.4, right? Yeah, 1.4. So I know that this is what I need to reach. And before that, how much did I have? I had 909. And from there, I am already selling off, which I can just sell refer to. Okay. Plus this. Okay, so I'm adding plus because it's already a negative this thing. Okay, yeah, so now it's come properly. So 691.6 or $692 million. Okay, I think it was that sign mistake that I made. All right, so additional investment that we require in the current assets, okay, is 692. That is being gained over there. Okay, so additional investment or gain in current, you could just say gain also. All right, so $692 million is that. Then what else is happening? Now non-current assets, so balance they said is in non-current assets. Okay, where did non-current assets go? The rest of the sales proceeds will be invested in non-current assets. So if you have to show over here, you sold it now. So basically you had this much, you sold this much, and you are supposed to have this much. Sorry. Okay, so you are supposed to have, wait, we have already done the calculation. So we'll just say that is equal to this. You could have easily done it directly over here also. Okay, this, how does this is already there, but this has gone out. Okay, so 6 million, again 6, again, oh, okay, wait, that calculation mistake again. Is just coming. Okay, anyways, we'll just calculate non-current assets. So non-current asset is the balance that happens. So if we have a total sales proceeds of 260, out of which we are investing additional, wait, not sales, sorry, that's the profit. So 1217. So out of this 1217, or balance left for what do you say, non-current assets or non-current assets adjustment. Okay, wait, let's just read if any other information is given or not. That is why I prefer having a summary, but since there wasn't time, I didn't make it, but it's just gonna end up taking more time. Uh, this we did, sales proceed, this we did, predicted after tax of this we are yet to use, 3.5 we did, loan notes 9%. So first we are doing loan notes, then we are spending for our current assets, and the balance is for non-current assets. Profit on sale of shoes, nothing uh, directly taken into the non-current assets of children's shoes division can be assumed 608. This we have taken into consideration. Additional investment in non-current asset is this much pre-tax. Okay. So how much are we left with? Balance cash left, you could say. Okay. So we had a cash of this much, all right, from which we spent this much over there. Uh, okay. This much this is what is left. However, we have also reduced our loan. How much loan are we reducing? 9%. Okay, so $350,000 is what is left. Okay, so $350,000 is what is left with us, which is going to increase the non-current asset. Okay, used to increase or buy additional current assets. Okay, so this is additional 350, which means that first we had this much, then we lost this much due to the sale, and now we are adding 350. So that's 942. Okay, so 942, 1252. So our current assets will be, total current assets will be sum of, right? So this is our total current assets. Our called up share reserves, called up share capital will remain the same. Okay, because we are not doing like a sale of shares or anything. So that will, or we are not issuing shares or nullifying shares, nothing of that sort is mentioned. Reserves is still a question mark because the profit needs to be added. All right, total equity, we don't know yet. Non-current liabilities, as we said, is going to turn to zero. Loan notes, the 7% loan notes will remain as is. Bank loans will remain as is. Total non-current liabilities, so is equal to sum of, okay, wait, did I take it correctly? Why the two? I think this was a typo. Let me just see. Does this all add up to 420 is equal to sum of, yeah, 428. So this is 253. Just format it, shift it one cell. Okay. Right. total equity will basically be, we don't know yet, so I'm just writing this as 0, or not writing anything at all, is equal to sum of this and this. Current liabilities will remain as is, and total equity plus liability will be this plus this plus this. Okay. Now, the easy way out would be, you can just find out what is the balancing figure. Okay, so if you know that this is 1197 and you need to make it 2194, so ideally your this thing will be, okay, so you just have to, which we don't know, reserves. So you can just directly do this. So this is not the right answer. This is more of a, like a double check. Okay. So 997 should be the addition to your reserves, which means that there is already 737 on it. So additional which is being added will be so this 260 should be the ideal additional profit that you should be generating. But this is not the correct way. This is just a way to check it. But if in case you are short of time and you just want to quickly give an answer, this is one way of approaching it. Anyways, we won't do that. We will solve it. Um, so now we can look at the impact on the EPS or the profitability, right? So they are saying then that the predicted after-tax profit for children shoe division in year one can be assumed to be uh, 76 million. The total after-tax profits for Hanwood Shoes Company for year one, if the children's shoe division is not sold, is predicted to be $217 million. Okay, that means, let's just put a heading first. Impact on EPS. Okay, all are in dollar million terms. Okay, so predicted post tax profits. Okay, so current forecast and revised forecast, or which is basically after sale, we could say. All right. So they are saying that if the children division wasn't sold, is it? The predicted, okay, that is the forecasted after tax of children shoe division for year one can be assumed to be 76 million. Okay. But if the total after tax profits for Hanwood shoes, if the children's shoe division is not sold, is predicted to be 217 if not sold. Okay, so if not sold, that is current forecast is 217. All right, and revised will be 207, but we are selling it, so less profits from children shoes. Okay, how much is that? That is 76 million. Okay, can be assumed to be 76 million. Less 76 million. Okay, then what else is happening? When we are selling, what else is happening? Okay, so we have taken now let's see if we have used all information. We have used this, we have used this, we have used this. Yeah. Year 4 free cash flow, we have used this. Proceeds of selling 9%, we have used this. But over here, so they have said that this interest we are, as in this loan we are repaying, that means we are not going to face this interest. Okay, so that is going to reduce our interest costs. So let's take that into consideration. Okay, so we are reducing. Okay, so add interest saved, the 9% loan due to repayment of 9% loan. Okay, just to make it more clear. All right. Now, how much was it? 175 into 9%. Okay. But we also used to enjoy a tax shield which gets reduced. So we'll do 1 minus T. So tax was 20%. Okay. So $13 million is what we are adding as interest saved. We do not have to, you know, pay that much interest. Okay. Now, what else are we doing? Um, this is done. Profit on sale of children's shoes division would be directly taken into reserves. All right. Non-current, this we have taken. Additional investment in non-current assets is expected to earn a 18% pre-tax return. And this is going to earn a 6, in current asset is going to earn a 6% pre-tax. Okay. So, what is it? 18 and 6%, right? Add returns or additional returns on this thing, what do you say? Fixed assets on non-current assets and CA. Okay, non-current assets, which is we are doing 18% on the additional non-current assets. So that's 350 million. Okay, and this is pre-tax return. So we need to do 1 minus T because we are taking post-tax returns. Right, so $50 million is the additional returns on the non-current assets and additional returns on current asset. Wait, let me just write it. This is 18% pre-tax. Okay, but we need post-tax. So this is what was this? I think 6% pre-tax. Right, let me just confirm. Yeah, 6% pre-tax return. Okay, so 6% pre-tax. Right, so over here, now how much is the additional we are doing? That's 692 is the additional investment in current assets into 6% into 1 minus 20%. Sorry, 0.2 or 20% you can write. So I've shown you both, one with 0.2, one with 20%. Okay, so your profits will be, or we could say adjusted, will be sum of all of this. We have already shown the sign change. So we can just add it as is. Let me just put all of these in dollar terms. Okay, so adjusted profits will be $237,000. All right. What was it otherwise? If nothing was done, then it would have just been $217,000. Now, number of shares. How much is the number of shares? So, our equity share capital is 50. And now, is there anything given on the face value? I don't think anything is given on the face value. So we will assume, we can write an assumption that we are assuming that they are a $1 share. Okay, so number of shares will be 50 divided by 1. Let's say, assuming $1 face value. Okay, so this is not in dollars, this is numbers. Okay, so 50 million shares, therefore our EPS will be this divided by this. So your number of shares is not changing. This is million shares. This is $1,000,000. This is also, this is just dollars. Okay, just to be sure of your denomination. Just giving one additional clarity. Okay, so 4.7. If it's always a good idea to show EPS in two decimal places. Okay, so 4.75 and 4.34 will be our EPS change, as in the impact on the EPS. All right. Now, since we are running short of time, I'll skip the theory part. You can easily write the theory part, discuss whether the Hanwood company's investors are likely to be satisfied with this proposed sale of children's shoes divisions and the consequence for profits and funding. So speak about the profitability, speak about the funding. Okay. So if you see profitability, at least EPS seems to be increasing. So that's a good thing for the company. Yeah. So again, now wait, we found the profit 237. So this needs to be added over here. This reserves gets it needs a 260 reserves. Oh, this is just the additional profits that is okay. This is the adjusted or revise. This is just the additional profits that we are going to make. Wait, for some shoes, additional returns, additional returns. Okay. So I think this is just the additional returns. There is a minor because otherwise there is a $260 requirement unless anything else is given with respects to the profitability. Additional investment in non. Okay. Loan is. I think with back calculation, we'll just write that because we don't know. It doesn't seem to be adjusted profit is 237 million, but again, this is just a forecast, but it would be 260. Wait, or just why is it coming off? Oh, because we have done a cell referencing there. Oh, it's dependent on this. That is why. Okay, anyways. Uh, 237 million will be your adjusted profit, and we can find out how much is by how much is our reserves increasing. Okay, that is 260 million, which is the total that we are earning between the two. Okay, is there a mismatch? No, the answer seems proper. Yeah, adjusted profit, number of share. Yeah, so we can just stop there. Now the theory part, I'll leave it on to you, but you need to mention all the 3 points. So you can write that sales. So you can speak on. So part B. Okay, you can speak on the sales. You can speak on the profitability impact. Okay, and you can speak on the funding aspect. Okay, these three things needs to be covered. What is happening? What are the impacts? Okay, everything needs to be covered. If time is there, we will come back to this. But for now, we are just moving on to question number one, Zinchi. Okay, what are we asked to? Now, this is a proper case study. So initially, I thought of taking three 25 markers, but then I thought, let me just stimulate the exam instead, and I have included a 50 marker. Um, but the main solving part is much smaller, as in it's going to take a less time. So let's do this. Let's take a 5-minute break and then come back to this question because I understand we've been doing it for an hour. So let's take a quick 5 minutes break, right? All right, welcome back. Wait, just a moment. My screen and the background is changing. Wait. Yeah, got that thing fixed. So let's move on to question number one, that is Zinchi. Before we read that, let's read the requirements. This is a 50 mark report style of question. So prepare a report for the mode. Okay, so first one A is says that discuss and justify the actions Zinchi company should take to address the three financial strategy policy feature failures. So only when we read the case, we'll know what failures are they speaking about. Prepare a report for board of directors of Zinchi company, estimate an appropriate discount rate to use. So in this report, you have to estimate an appropriate discount rate to use to determine the NPV of a project based on all equity finance. So we can just stop at asset beta. Estimate the NPV of the new project, assuming that it is an all equity finance project. Okay, so the NPV also needs to be calculated using that cost. Then estimate the APV of the new project. So APV treats as if it is an all equity finance project, and then you put in the financing effect. And evaluate whether the new project should be undertaken and discuss the assumptions made in the estimates above and discuss whether the adjusted present value method would be more appropriate than the conventional NPV to evaluate the new project. Okay, so advantages, or in which cases do we use APV, all right, versus NPV. Now let's read the question now. The following exhibits explain on the left hand side on the screen. As I said, on the left hand side, all these things will be there. Your question, and right hand side is your solution. So Zinchi company's policy failure, new project discounting rate. So these are the what do you say, information. So you can just click on it and it will open that. All right. So let's read the question. Zinchi is a large listed engineering company involved in the development and manufacturing of environmental friendly products for the business worldwide. Until a few years ago, the value of its shares has been consistent, increasing steadily, and its share outperform its rivals. Right. However, more recently, its shares have been underperforming, and many financial analysts are recommending that Zinchi company shares should be sold. Zinchi investors are becoming increasingly concerned. So the analyst community is recommending a sell call on Zinchi. Analysts concluded that the underperformance was due to three policy failures. So on this, we have to write. So the first one is Zinchi does not take a completion audit, post completion audits of its investments. Okay, then Zinchi has used a fixed discounting rate of 10% to assess all investment projects for some years now. None of the company's seniors management can remember why this rate was chosen. And Zinchi has continuously funded new investment projects using equity finance, and analysis concluded that this financing strategy sent the wrong signals to the investor. So we need to write on all these three things. Okay, so why is post completion audit important? Okay, just to understand whether you are meeting your estimates forecast or not, whether the reality is equal to your forecast, whether the project is actually NPV positive or not. Okay, that needs to be that analysis needs to be done after the completion of the project. Okay, and it can also help us understand how to forecast for the future projects. So all those things from your text you can answer it. Okay. Then next one is why we cannot use, or because see, every project has a different risk. So the WACC would change. So you have to write all of that. So we cannot basically keep using the same WACC for all projects, right? It will give a distorted NPV on which the final decision is made most of the times. And projects using equity finance. So why is always using equity financing the wrong way to go about it? So you can speak about there are internal sources. You can speak about how debt is cheaper than equity and how equity expensive. Okay, all of that. And what signals does it bring that the company doesn't have confidence to take a loan, or what, since it's cheaper, why is it going for equity always, when, especially now, only when we see the debt to equity of the company would we know. Okay, we could comment on it. But yeah, so this is on the funding strategy you need to comment on. Now, new project discounting rate. Zinci company is considering a new project to manufacture environmental friendly motor scooters which are fully carbon neutral. This is a diversification, a new business area for Zinci. So Zinci has never done scooters before, so it's doing a carbon neutral Zinci motors rather, in which it has no previous experience. Zinci company's CFO is of the opinion that Zinci should determine an appropriate discount rate for the project based on initial assumption that the project will be all equity financed. Okay, so that's one assumption we are making here. Liu company, which would be a competitor to Zinci, is as it is also a manufacturer of environmental friendly motor scooters as well as equipments of farm. So Liu is another company. We can use it as a proxy. However, Liu itself is doing two businesses. One is wind farms, okay, and motors. So 60% of Liu's business is scooters and 40% is wind farm, so that we can use as a proxy beta for Zinci. But for Liu, let's see what else is there. Given below is the most recent financial informations of Liu. So share capital, reserves, market value of equity, market value of debt, and equity beta is given of Liu. Then San Venue company is involved in the manufacture of equipment of for wind farms. So now they have given a competitor to Liu, who is only into wind farm equipment, okay, has estimated its cost of equity to be 15.4, and it is financed 20% by debt and 80% by equity in market value terms. So what we can do is we can find the asset value. So since we have, wait, is involved in manufacturing of wind, it is estimated its cost of equity is 15. So here already the cost of equity is given, and so that is your this cost will be based on your equity beta. Okay, so you can find the asset beta of the wind farm business and then accordingly make changes to Liu and then find out our Zinci company's beta or discounting, as in beta, and then find out the cost of equity. And since it's an all equity finance project, it will be the discounting rate as well. The estimated risk-free rate is 4.8% and the market risk premium is 8%. The corporate tax is 20%. So this is information relating to your CAPM model. New project cash flows will be. So I think before we read entire of the next question, ideally we should be reading it. But since there is shortage of time, we'll just stop here and we'll start with the solution part. Or okay, let's just read it quickly. Zinci company expects the new project manufacturing environmental friendly motor scooters to last for 4 years. The project will require an immediate expenditure of $70 million for plant and machinery. So that's our initial investment. After the project ends in 4 years' time, it is anticipated that the project will be sold for $42 million, inclusive of any inflationary increase. So at the end of the project, we are selling it for 42 million. The following estimates of revenue and cost relating directly to the projects has been made. In the first year, sales revenue is expected to be 10 million and then increase to 40 million in year two. And then in the final 2 years of the project, sales revenue will grow to 20% each year. Costs are estimated at 120% of sales revenue for first year and 80%. So this is with relating to the cash flows. Okay, substantial initial working capital. So this is relating to working capital. This is relating to tax, tax allowable depreciation, and all of that. Okay, so we'll come to that a little later. Find out the due to the positive environmental nature of the new project, Zinci company can obtain the entire funding for project through a loan at a subsidized interest rate of 180 bips point lower than the risk-free rate of 4.8%. Zinci company's normal borrowing rate is 6%. Zinci has sorry, Zichi has decided that the project should be entirely funded through subsidized loan. Issue costs, which need to be paid, are anticipated to be 3% of the gross. So this is going to help us in APV. Okay, given that the new project is to be funded by subsidized loans, Zichi CFO is of the opinion that the adjusted APV of the project would be more appropriate than the conventional based on risk-adjusted cost of capital to evaluate the project. However, he cannot explain why this must be. So this they have already asked us. Okay, so in our report, we have to cover all these 4 points. All right. So firstly, so this is section A. I just gave like a guideline. These things need to be highlighted. Then part B, we can write a report to the board of directors, each company from financial management. The subject, financial manager, subject is appraisal of investment of manufacturing of carbon neutral motor scooters. Okay. Now that's so basically this whole report is on the appraisal part. Now introduction, so you can talk about what is going on over here. We can say that Zichi company is considering or this is a report calculating whether Zichi company should invest in motor, and then we are going to use NPV and APV in it. Okay, so all that you can write as an introduction to it. So introduction you can actually it's just like a one paragraph, okay, what you are going to do, okay, and what is being what is the report all about, okay. It's like um, evaluating whether the new project should be undertaken, okay. So this report evaluates whether or not the new motor scooter project should be undertaken or not, okay. And then uh, we are also like we have to discuss the assumptions made, so we are discussing the assumption made in estimating the value of the project, in estimating the NPV, the APV, all of that. Okay, and then we are also discussing which is more appropriate. So it's kind of like a summary of this that you can write as an introduction because this is the gist of the report. Okay, then comes next part is evaluation. Okay. What are now? See, the structure could change if you want. You could write even assumption first if you want, but well, you can just write evaluation because in the question, I think they have asked estimate, estimate, estimate. Okay, three estimates are there. So we are evaluating three things. One is the cost, as in the appropriate discounting rate. Then we are calculating the NPV, and then we are calculating the APV. Okay, so we are doing that. In order to do that, what are the assumptions we are making? So in beta, we are making certain assumptions. In NPV, we are making certain assumptions. In APV, we are making certain assumptions. All of that needs to be highlighted. APV or NPV. So we are comparing APV versus NPV and then finally concluding. We have written this because it is explicitly asked over here to compare the two. That's why we have included this. Okay. Other factors to be considered can also be included in the report depending on the time you have, but I would recommend you have it. And then finally the conclusion. Okay. Now let's start. Now, whatever you write in the evaluation, you need to give reference to your appendix, that is the calculations. Okay, so you can then after this report have a statement, write it this way, or maybe your report is written in your word processor, but the calculation is done on the spreadsheets. Okay, so you can write appendix. Okay, and then you can say this is appendix 1, which is calculating the beta. Okay, beta and uh, discounting rate. All right. So firstly, we had three companies, so we can start off with Sun. What is the spelling? Or let's just say, just write it. SANWEWNU. Sanyu company. Okay. Now, what all things do we have? We already have the equity beta of Sanyu. Where is it? Okay, so Sunview equity beta is, I'll actually do the calculation just on the side so it's easier to understand, as in I don't have to keep scrolling. So equity beta is 15.4%, which is equal to the risk-free rate, that is 4.8% into beta. Okay, do we have the beta available over here? Um, its cost of equity is 5.5, finance 24%, 80% debt. The risk-free rate is 4.8, market premium. No, so the beta is not given. So into beta into market premium. Now market premium we already have. Okay, so it's actually not into, it's plus. Okay, beta into the market premium, and market premium is risk premium is 8%. All right. So we have these, like this is the equation. Okay. So what we can say is the equity beta will be, okay, it's just taking things on the other side. So it will be 15.4% minus 4.8%. Okay. Divided by, because that whole thing is going on the other side. Okay. Divided by 8%. It's just rearranging of formula. So this is your equity beta, and then from here you can find out your asset beta. Okay, this is taking a lot of space, but all right. Asset beta is equal to equity beta into, now component of equity. So equity is 80%. So 80% divided by 80% plus 20% into, remember, put the multiplication sign, 1 minus t, that is zero point 0.2. Right, so your asset beta is, let me just, okay, 1.1 is the asset beta of this thing. So I'll just copy paste this. Okay, everything, nothing is cell referred, right? No, I have cell referred. Just writing it over here. Okay. Yeah. So my asset beta is available. Now we say that there is an assumption being made that this asset beta of 1.1 reflects the business risk attributable to manufacturing of wind farm equipments. Okay. This is an assumption that we make, that when we take 1.1, it is asset beta, it is just reflecting the business risk of that business. Okay, which is wind farm, because San Venue is only wind farm. Okay, but we need to be aware that this is an assumption and this can be written over here. Okay, this is just, we need not write this over here. This is mainly to be written over here. But I'm just mentioning it over here so that you remember we have to make this assumption here, right? Now we found out this company is San Venue. Let me just bold this company. Okay, so now we can calculate Liu companies. Let me put it in a next line. So for Liu, let's see what all information do we have. Now for Liu, okay, which is actually a direct competition to this company. So they have said that 60% of Liu companies is motor scooter and 40% is wind equipment, and given below is the most recent financial information. So equity beta of Liu is, so we have the equity beta of Liu, which is 1.2. Okay. From that, if we have to find the asset beta, so asset beta will be equal to equity beta into the market value of equity, this, I hope it's taking the right cell. Okay, this divided by wait, market value of equity. Yeah, this divided by this plus the market value of debt into 1 minus T, it's 20%. Okay, and we close it. So 0.98 will be the equity beta or asset beta for this company, for Liu. All right, so these two information is there. We will just copy paste it. Okay, I'll just directly take it to the calculation where we made it. Right, so 1.1. Okay, now this asset beta, this is the 100% company. We know that 60% is a motor scooter and the balance is this thing. Wait, was it 1.1 or was it something else? Wait, sorry, 0.98, 1.2 and 0.98. Cell referred it to the wrong cell. Okay, so 0.98. Okay, now we know that this is not entirely of the scooter business. All right, so asset beta, which is 0.98, is equal to zero point 0.6 or 60% of, or of is basically into, okay, into the asset beta of motor scooter business, plus it is 40% of into the asset beta of wind farm business. Now, asset beta of wind farm business is 1.1, which is already available above. Okay, so I'll just not write is equal to, just write this for your understanding. So 0.9, so if you just have to rearrange this, asset beta of motor scooter business will be, now again just rearranging, so 0.98 minus this thing, 40% of 1 point, so 40% of the asset beta per year. Okay, divided by 60% or 0.6, anything. So this is our asset beta. All right, wait, there is some mistake. This is one whole number. Okay, yeah, 0.9. Right, so asset, there was a bracket mistake, that's why. So be careful with the brackets. So this is the asset beta of motor scooter business. That is 0.9. So we can also just make this. All right. Now again, same assumption that this purely shows the business risk of the motor scooter business. Now for our company, that is ZG company, ZHI, ZG company. right? Now we need to find our asset beta. Okay, so asset beta will be the same as our proxy. Okay, so we are taking Liu company's asset beta. Now it is said that we assume it is an all equity finance company, so we need not gear it. Okay, this is the de-geared beta that we have, ungeared beta. We need not gear it with our debt to equity structure because it is said that assume that it is all equity financed. All right, so we can just stop over here and then we can find the discounting rate or cost of equity. So uh, base case discount rate, which is cost of equity, is equal to risk-free rate plus beta. So our risk-free rate was 4.8% plus beta, okay, into your market premium, and market premium was 8%. All right, so your percentage is 11.98%. So that is almost 12%, you can say. So this will be our base case discounting rate, right? So we can just mark this, highlight it. So that's subsection 1, wherein appropriate, if it is an all equity finance project, okay, appropriate discounting rate. Since there is no debt, okay, there is no question on cost of debt, there is no question on WACC and all of that. So it was easy. We had to just stop it there. But calculating the appropriate beta was a little challenging. Now moving on, next question, estimate the NPV of the new project. Now, so we can write that as the second appendix. All right, so appendix number 2, calculating the NPV of motor scooter project, and assuming it is all equity financed. Okay. In fact, over here also you could have written discounting rate, all assuming all equity financed. Okay, actually this is a WACC, and so your WACC also will be same. So I won't write explicitly its cost of equity. Okay, so this now let's just see what all information is available with regards to our cash flows. There was one paragraph on that. Yeah. Expects the new project manufacturing environmentally project will require an immediate expenditure of 70 million for plant and machinery. Now, whatever our capital cash flows are, we will write it at the end. So we'll leave this for the end. In the first year, sales is 10 million. Okay, so first year sales is 10 million, and then increases to 40 million in year 2. So, and then it's 40 million. In final 2 years, the project sales will grow 20%. So into 1.2, 1 plus R, okay, 20%. So 48 million. And then the same thing gets copied, 57.6. So this is year 1, year 2, 3, 4. Okay. It's a 4-year project, right? Year 2 and each year. The costs are estimated at 120% of sales revenue. And so this is your sales, and then cost of sales. So cost of sales is 120% in the first year. So into 120%, that's $12 million. Now this is an outflow, so it's a negative, right? And then what else do we have? First year, and 80% of sales for second year before reducing to 40%. So then it becomes 80% of sales. And then it reduces to 40%. Okay. This is 40%, 40%. Right. So this I'll just take it. Right. So I have everything. Okay. Sorry. All these are in dollar terms. Okay. Or rather dollar million. Right. Everything is proper. Yeah. Yes. Okay. So this is our cost of sales. Now what else do we have? Pays a corporate tax of 20% per year, and any loss from project are set against company's profit after profit from other project. Tax allowable depreciation is available on a expenditure on plant and machinery at an annual rate of 15% on reducing balance method. It is anticipated that the plant and machinery will have a realizable value of 20 million, and its realizable value is included in the project's estimated sale price of $42 million. Okay, so 15% is the tax allowable depreciation. So TAD, all right, at the rate of 15%. Okay, then less tax, and then we will add back TAD. Okay, tax is at 20%. Okay, now 15% of what? Our asset price. So we can also then write our initial investment. So initial investment will be year zero. You can write year zero. These are years. Okay, so year zero initial investment will be where's our initial investment? Where do we calculate our sales and everything over there somewhere? $70 million seems to be the initial investment. Okay, 70 million for plant and machinery. 4-year project will be sold for 42 million. Okay, so 42 million will be our selling price. So initial investment year zero will be $70 million. And then we have the sales proceeds or scrap. Sales proceed of the machinery in year 4 is it's an inflow. So it will be an inflow of $42 million. All right. Now we have to find tax allowable depreciation. So it is this into 15%. Okay, in fact, let's just make that working note for it. Okay, so if we had, we can make this as another appendix. Okay. Uh, Calculating the tax allowable depreciation. All right. So investment, initial investment $70 million. Then depreciation or tax allowable depreciation rather, 15% year one. And then we have our WDV. Okay. So that's our WDV. Then again, this is year one, year two, year three, and in year four, there won't be a depreciation in year four. Okay, in year four, we are directly selling it for $42 million. Okay, so this is what our value. This is year three, and then sale, and then balancing. So this is our balancing charge. Now, TAD is 10.5. Now here we will reduce it, 10.5, then equal to minus 8.9, minus 7.6. Okay, and last will be your balancing charge. Okay, so your balancing charge will be this. What happened? Okay, wait. Selling price was 42 million, right? No. So wait. The entire project will be sold for 42 million, not the machinery. So machinery is 20 million. Okay, so that is 20 million. Okay, so 23 million will be the balancing charge. This is basically not from the machinery. It's the project that we are selling off. 42 million is what we are getting at the very end of it. It's an inflow. Okay, then we just find out our cash flows or profits. Okay, we'll just write cash flows is equal to sum of right. Tax at 20%. Now we will shift it because it's 1 year in arrears. Okay, at the end, I'll just do like a batch formatting of it. All right, now TAD again, we have to add back. So whatever the TAD were, it is going to be added back. We just showed that to show the tax benefit on tax allowable depreciation. Okay, so that's that. No need actually, we can just do it as is. Okay, initial investment. And then lastly, there was working capital. So working capital investments. So let's do another appendix. Calculating working capital investment. Okay, so to calculate working capital investment, let's see what information is given for working capital. This is depreciation. Capital, firstly, there was a requirement of $10 million. So WC requirement is 10 million. Then subsequently, working capital of 15% of sales revenue for the year will be required at the start of year 2 to 4. So is equal to 15% of sales. Where is our sales? Sales is here. Okay, it's not coming properly. I'll just write it here. Okay, this is working capital requirements, and this is as of year 0, 1, 3, and sorry, 4. Okay, this is 15% of sales is required. Okay, so 15% of year 1 sales, or sorry, year 1 is already taken care of, so year 2 sales. What happened? Oh, put the is equal to sign. Okay, so remember is equal to, otherwise your calculations won't come. Right, so is equal to 15% into 40 is equal to 6 million. Okay, see, the requirements are before the sales that happens. Okay, so if you want to do a sales of 40 million, you need a $6 million working capital in place in the beginning of the year. Okay, so beginning, they have already given 10 million is required. Okay, this is working capital requirement in $1,000,000. Okay, so invested or released. Okay, again, all are in $1,000,000. In fact, you can write like standard disclosure also over here. So firstly, you required 10 million, so you are investing 10 million. Then what is the difference? You read 6, but you already have 10. Okay, that means a $4 million outflow, then inflow, outflow. Okay, it won't be like this. Yeah. So you already now have 6, but need 7.2. So you're going to increase your investment by 1.2. You want this much, but you have 7.2. So you will increase your investment by $1.44 million. And at the end, it's all going to get released. This is very important, everything getting released. A lot of students miss that out. Okay. So working capital. Wait, where is my answer? Yeah, working capital investment year 0. You can give a reference. Okay. Appendix 4. Your appendix 3. So you know where you are taking your figures from. Comes in TAT, right? Okay. So we have done all our cash flow. So net cash flow will be sum of all this. Okay, till your previous cash flows. Right? Let me just format this. Now all of this is basically dollars. Okay. And then we can just do our discounting in your NPV. All right. So NPV at 12% discount rate, which was calculated above. Okay, as per appendix 1. is equal to NPV 12% of all these cash flows. Okay, so your NPV will be $67.2 million. Okay, wait, working, this is an outflow. So it is this. Wait, working capital investment, right? So it's an outflow. So this will be 80 million, and then this is 1.8 or 2 million, 4.3. Wait, there's some issue with the sign, I think, that I have made. Tax is let me just highlight this. Okay, NPV is $62 million, but this doesn't seem correct. It's just a moment. This 80. So the tax at 20%. Yeah, tax is at 20%. Uh, this is an inflow. Wait, just a moment. Okay. Yeah. This is, oh, I forgot to put the negative sign over here. Right? These are your outflows. So cost of sales were negative. So two signs that we missed. That's why it's important for the signs because we added all of them up. Okay, so this all becomes 4.2. Wait, now this is less tax. Again, we have to put a minus sign over here. Forgot that. Okay, so yeah, negative, negative, negative. Right. So then our cash flow turns out to be 0.8 to 4.3. Some mistake over here. 0.5 TAD is 8.9. Okay, 1.2. Things are we considering? Our final cash flow is an outflow, outflow, inflow, and then an outflow. Okay, these will be an inflow. Okay, so this will be 3. Let me just There's something missing over here. That is 15% gets added back. Less tax is there of 2.5 is what we are paying as taxation. Just a moment. Wait. Oh, it's minus tax. It's turning out to be a positive figure. Since it's basically due to your cash flow, okay, due to your taxes, it's you are basically having a negative cash flow. On a negative cash flow, you are saving your taxes, so this will become positive. So basically, I'd not put a negative sign for the tax flow, and therefore there was this whole big mistake on the calculation. So the only change that needed to be done was negative sign over here and negative signs on cost of sales. Okay, so we arrive at our NPV of $1 million, but it is a negative NPV. So that's a loss making NPV that we have over here. Okay, now our so this is NPV. Now they have asked us to find the APV also. Okay, so now APV, if you see that there is a discounted loan that they are taking. So let's calculate the APV. Now the way we do APV is we take it as if it's a all equity financed project, and then to that we given the what do you say, the impact of financing cost. Okay, so how we are going to do it is, so we can make this as a new appendix. Appendix 4, that is evaluating, or can just write the same thing for appendix 3. Not NPV now, APV. Okay. So for APV, as we said that firstly we'll do that, what is the value, NPV, or base case NPV, base NPV, which is all equity financed. Okay. So that is, now this will be in dollars. So our base case NPV is a negative $0.9 million. Okay. Now to this, we will add, we will put in our issue cost. Okay, so issue cost will be now, what is our issue cost? New project cash flow, financing the new project. So due to the positive risk-free rate of 4.8%, borrowing 6%, so we will discount at 6%, or we can borrow it as risk-free rate, anything is okay. Which he has decided the project should be, issue costs need to be paid are anticipated to be 3% of the gross finance required. Okay, so 3% of the gross financing required. So it will be 3 divided by 97 into the gross finance required, and the gross finance required is 80. Okay, so this is our issue cost. So 2.47 or $2.5 million is our issue cost. Then we'll do our tax shield. Okay, uh, because we are paying debt, so there is some tax shield that we are going to enjoy on it. Okay, so how do we calculate our tax shield? So to calculate tax shield, now issue cost of debt and equity. Okay, here they have just given a blank statement of the entire funding, so we are going to take it as is. Now, so the tax shield. So annual interest rates payable Okay, so what is the interest rate? So we need a funding of $80 million. Okay, and what is the cost? The subsidized rate for us is 180 bips lower than 4.8%. Okay, so that's 0.048 minus 0.018. Okay, so it's basically 3%. So this 3% into your tax sheet. Okay, so your tax, so that's into point. Okay, so $0.48 million. Okay, this is all dollar million. All right, so annual interest rates will be this much. Now we have to say what is the PV of this interest payable. Okay, so the present value of this. So you can say that, well, it is an annuity, but the tax effect is one year delay. So first we'll see, one way of doing it is putting it over here and say that, okay, or wait, I'll just show you how it's done very quickly. PV of interest rate will be this into the annuity factor. Okay, and then it will be double discounted. Okay, so uh, into the annuity factor. Now if we don't have the annuity factor, or we can just pull it off from our formula sheet. So let me just open the formula sheet. Okay, 6%. Okay, of 4 years discounting. So 6% annuity, 4 years discounting is 3.465. Okay, so this into 3.465. Okay, now this has to be further discounted by 1 year. Okay, so 6%. Sorry, that we lost connection. Okay, it's back now. So as I was saying that we calculated the base case NAV, we have the issue cost, we have the tax shield over here, and now we can calculate our. One more thing we had to do is subsidized loan benefit and cost. Okay. So what is the subsidized benefit of loan? So PV of subsidized loan benefit. Okay, so if you see, it is 80 million into, now we already know it's 3%. Okay, so 3% into the annuity factor. So that is 3.465. All right, so 8.3 million. And PV of the tax shield loss, because since we are paying lesser loan, so we are losing out on that tax shield, which is so on 80 million. Sorry, 80 million is equal to 80 million into 3% tax. Okay, into sorry, 3% is the rate of interest into 20% tax. All right, into, now you can do a double discounting. So into 3.465, because it's 1 year in arrears, same as above, into 0.94. All right. Right. So now we can just find out our APV. So APV is equal to, we start off with our base plus the issue cost, which is an outflow, plus Our PV of interest, whatever our tax shield is that we enjoy, that's a shield, so it's an inflow, plus the benefit, plus or rather minus, because we haven't put the sign, minus this. Okay, so $4.9 million, all right, will be the APV. We can just write this as a negative value if you want, but all right, we'll just keep it that way, right? So this is our APV. So only if you do it through the APV method, that is, we treat the financing cost separately, is it beneficial? Okay, which an APV is the better one. However, we need to highlight certain things that majority, if you see our cash flows, are major. So it's an outflow, $80 million outflow. And then there is a small inflow, and then meaningful inflow is coming only after year 4, 81 million. If this wasn't there, okay, or after 3 years, 27 and 81 million, these are the big cash flows. So that you need to highlight over here, that, where is it? In our report. Okay, so introduction is done, evaluation is done. So in evaluation, you are evaluating your NPV, you are evaluating your APV, wherein you are saying that if you are doing through the NPV method, then it is negative. But if you are going to treat the financing costs separately, then using APV, the project is positive and we can do it. But keep in note that the major cash flows are coming after year 3 and 4, or majorly after year 4, and they are susceptible to a lot of forecast, because we don't know what our cash flows are going to be after 4 years. So that needs to be done properly, as in that needs to be kept in mind. Okay. So that's our evaluation. You can also suggest a further calculation of sensitivity analysis over there, assumptions, whatever assumptions we made to calculate beta, whatever assumptions we have made in the NPV calculation, all of this is an forecast or an assumption ultimately. Okay. And whatever assumptions we made for our APV calculation. So all these three assumptions you need to mention, then APV or NPV, okay, that needs to be done. And then the final conclusion. So you can, in the final conclusion, mention that if you see that both the projects are like in NPV, it's a negative $1 million, and in APV, it's a positive $5 million. But that's a too small inflow or growth for a $80 million investment. So if there is slight change in your forecast, that final answer could change. However, for now, given the above assumptions and calculation that we have made, APV, and we have also discussed why APV is more appropriate, we will go with it, but be careful about these changes in forecast. Okay, so one small conclusion and more detail. So more detail will be in your evaluation. A conclusion will be a smaller paragraph. Okay, a small 2-3 line conclusion. And with that, we are done with the question. So I'll just quickly tell you the major conclusion is NPV is negative, APV is positive. So we go ahead because APV is better suited for this particular company. Okay. However, this is only because of the assumptions and calculations we have done above as in the appendix mentioned. Okay. Please note they are sensitive to changes in forecasts. So sensitivity analysis is recommended. And also one thing to note is major cash flows are coming after year 4. The prediction or the forecast of which may be a little uncertain. Okay. So that will be your final conclusion for this. So with this, I know we took a lot of time because I was explaining as well. Okay, with this we'll we'll end for the day. Okay, so I hope things are clear. I hope you got a feel of how the paper will be. We shall now